Welcome back to Everyday Economics. It's the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, CEO of the 501c3 nonprofit Franklin News Foundation. Everyday Economics is a production of America's Talking Network. You can check out all of our podcasts at americastalking.com. To support podcasts such as this one, please make a tax-deductible charitable contribution by clicking the link in the show description. We are recording today's episode on Friday, January 19th. And joining me, my friend, my colleague, the esteemed Dr. Orphe Divounguy. He's a PhD economist. Dr. O, you and I are, of course, in the Hall of Giants among podcasters here in the United States. I'm completely kidding. We've done some fun things, and we enjoy our show.
Man, I thought you were serious there for this. I mean, I thought we were in the top 100 podcasts on Apple Podcasts.
We have done that.
Serious.
We have broken through in the Apple top 100, and we couldn't have done that without the people that tune in and listen to us, and we're grateful for that. I guess you don't have to tune in on a podcast. This isn't radio, but the people who click. When you're
5'7.5" like I am, every time I hear giant, I feel good about myself.
Well, you are a giant, and I hold you back, but you do a good job of overcoming my ineptitude in the world of economics, and we have fun with this. Where I'm headed with my opening remarks is that you and I have the opportunity to get together probably once a week. We produce these podcasts in, batches of 3 or 4, or sometimes only 2, depending on what time that we have, because we have other stuff that we have to do. We're not professional podcasters. We don't pretend to be. I have a curiosity in the economy, and you're an economist, and that's what makes our show fun, I think, for me anyway, and hopefully for the audience, and hopefully for you too. I feel for the people who I watch on television, on CNBC, on Fox Business Channel, who have to talk about what is happening in the economy in real time, day after day after day, for hours, at a time, because it's like they're filling space, right? And they have to try to find some sort of insight from some kind of movement, seizing on a headline or speaking in general terms about trends and whatnot. And they've got to do that every day in virtually in real time in front of a live audience. And we don't. But, one thing I wanted to ask you, was this. And I do not want to criticize the people that are out there that are doing what they're doing on CNBC or Fox Business or any of the other channels where they're talking about the economy in real time. But a lot of these people are geared, frankly, toward stocks, that largely the programming that exists around, cable news, business, economics, whatever category you want to call that. There are Wall Street people, who are monitoring Wall Street people and trying to offer some level of insight around individual stocks, what's going on with these companies. And again, they're doing it in real time, and I feel for them. So I'm going to ask you a question, finally getting to a question. What is it about Wall Street that they don't get about the U.S. economy?
Honestly, I listen to everybody, and maybe Wall Street gets it. I don't know. I just listen to a lot of people, and I think ultimately some of these pundits need to realize that a strong economy is a good thing, is good news for the stock market. Let me say that again. A strong economy is good news for the stock market. I think a lot of people, I hear people say good news is bad news is good news. We got the strong sales report, we got the strong jobs report, and this is terrible because yields are going to go up. And right, what they forget is that the strong jobs report means people are employed, people go out and spend. Yes, of course, that puts pressure on inflation, but as inflation rose, profits also increased. And of course, the stock market did really, really well. And so maybe the fear is that the Fed's going to step in and that we're going to see more tightening, but that's not going to happen. It's not going to happen for a number of reasons. We know that despite kind of slowing down of the kind of this disinflationary process in the last month or so, we know that there's a ton of disinflation in the pipeline. All you have to do is look at the Zillow Observed Rent Index. Rent makes up nearly half, 42% of core inflation. And we have a ton of rent disinflation in the pipeline. Rent growth has fallen to normal levels. Rent growth is normalized. You still have a lot of housing being built, especially in the multifamily space. So there's a lot of downward pressure on rent growth. That's going to show up in the official inflation figures with a lag. The Fed knows this, and the Fed has already pivoted to potentially cutting interest rates in 2024. The fact that we didn't get a major commodity price shock despite the stuff that's going on abroad in the Middle East and elsewhere, that's good news. The fact that inflation expectations are declining, that's also good news. The Fed is going to have to cut interest rates in order to prevent real rates from rising and policy from becoming even more restrictive. And so all of these factors are tailwinds going into 2024. And ultimately, the pundits need to realize that a strong economy is good news for the stock market, and not the other way around.
Yeah, well, and I appreciate your thoughts on that. I mean, the indicators. I mean, is there any way for the people at home to, process on their own? Like let's create a learning opportunity here, right? Is there any way for the people that are listening at home to process the indicators that they have access to, obviously through the websites that I just referenced or the TV channels that I just referenced and their corresponding websites, so they can sort of process this and learn along on their own?
Yeah, I mean, I track the labor market, I track the housing market to figure out what's happening with the U.S. economy. But really, the advice I give everyone is to just sit down and try to compare the headwinds versus the tailwinds.
Yeah.
Right. And so, we in order to figure out where the economy is headed. And so going forward, we have a bunch of tailwinds. We have disinflation. Low and stable inflation is good news for the U.S. economy. Low and stable inflation will lead it to extend the economic expansion, right? It will actually get the labor market. The consumer will get more space, and it will help support the consumer and keep the economic expansion going. So that's a good thing for the U.S. economy. And so I pay attention to the inflation numbers, right? Mm-hmm. As well. So, and the other thing is inflation expectations. I think the New York Fed has a very nice survey where they try to capture inflation expectations on a monthly basis. And so remember that what do inflation expectations actually tell us? Well, it tells us that if people expect prices to fall in the future, right? Well, what do you think they're going to do? They're going to stop spending today and wait till prices are lower to go on and buy stuff.
Right.
And so falling inflation expectations tell you that the consumer is already slowing down.
Yes.
And because the consumer is already slowing down, the Fed does not want to be raising interest rates now, because then it could usher in a big economic contraction. And so as inflation expectations decline, the Fed pulls back and says, okay, well, maybe policy is already so tight
We could just wait it out a little bit, see what happens. But we're definitely not going to be raising interest rates again. We're going to wait. And that's what the Fed is doing right now. They're waiting to make sure that the inflation genie is back in the bottle. But so that's what I'm paying attention to. We started this conversation talking about Wall Street. I think, when people say good news is bad news is good news, I hear that a lot on TV and on the Wall Street pundits. I think they're wrong, essentially. I think, we know the Fed has already pivoted. We know things are headed in the right direction. There's a very small chance, of course, that inflation could pick up again. But if it does so, then the stock market's going to benefit. It just means the economy is very strong. Today, for example, we're seeing yields increase, and we're seeing stock, the S&P 500 increase at the same time.
Yeah.
Right. So I am not so worried about it. I think what Wall Street should really worry about is a struggling consumer. Wall Street should worry about a potential economic downturn. Because if consumers are struggling, then they stop spending. And then that's when, some of these companies that are publicly traded could start to feel the pinch a little bit.
Yeah.
And so that's why I say, a strong economy is good for the stock market, whereas a weaker consumer, a weak economy is bad for the market. The fact the Fed is pivoting to potentially cutting interest rates means the consumer is slowing down, but it also means that interest rates cuts could prevent, a contraction in economic activity.
Yes.
And actually help to extend the economic expansion that we're in right now. And again, that will be good for stocks.
Mm-hmm. Well, thanks for taking us to school as always, Dr. O. For Dr. Orphe Divounguy, PhD economist, this has been Chris Krug. Subscribe to Everyday Economics at americastalking.com.
Enjoying our podcast? Your reviews help other listeners find our show. Please leave us a review on Apple Podcast, Spotify, or wherever you listen.